All right, so today, I mean, what we've headed this is Business Finance 101. So really the intention is to try and keep it as simple as possible. It is from the ground up in terms of helping you understand what goes on in the world of accounting and presenting balance sheets and income statements. So we'll take you through costs, profits, and income. What's the difference between a markup and a margin? How to read an income statement? What's an asset versus the liability? And then out of that, how to read a balance sheet. And then probably the most important thing is cash, and why is cash king? And then how do we really know if we're winning? What's going to tell us, yes, we got cash in the bank, or yes, I got some profits, but does that really tell us how we're winning in business? So first concept, cost and profit. If you have a look at it, I mean, simply put, profit is the income that you earn minus the costs that you incur in going about your business on a day-to-day basis. Or you could say, conversely, it's your revenues less your expenses. Now, what's the difference between a cost and expense? Not a lot, but there are some subtle differences which we'll explain shortly. But a lot of these words are used interchangeably, so nothing to worry about. Key principle is money in, money out. That's the money that you make, or the profit. Now, loosely put, income or revenue or turnover, those words in different industries can mean different things, but essentially for most people, it's the same thing. So how would you calculate what your revenue is? Again, typically it would be the sales value of the goods or services that you offer and sell on to your customers. That's often calculated by the units that you sell times the selling price that you make for it. And essentially, the true measure then is, what is the cash that you actually receive at the end of the day? So maybe there's some discounts that you give that you may have to also reflect in there. So if you have a look at that little box on the right-hand side, you'll see there a little chart that just shows you how to do the calc. So units sold times selling price, 20 times 50 would give you the revenue, 1,000 Rand. And then if you gave your customer a discount of 10%, you would expect to collect in cash from your customer a net revenue of 900 Rand. So nothing too complicated about that. Similarly, if you're selling time, how many hours would that be? What would your price per hour be? Same principle. And then on the other hand, so how do we measure the cost of what we sell? So here we tend to focus just on the cost attributable to the product or the service. And things like other overheads and things don't get factored in here. They get factored in later under expenses. So typically cost then is a value that's associated with the good or service in enabling you to present that to your customer. But it's not necessarily every single cost in running your business. These are the ones that you can identify that are linked to servicing your customer. So anything associated with producing or buying and selling of goods, and then any expenses that provide your income, you would incur as part of your expenses. And I think the important point to remember, you're in business, so personal costs are not supposed to be included in your business expenses. It's really any expense incurred in earning the revenue that you earn through your business. Now, can you go ahead and do that on your own? Yeah, absolutely. If you want to include your partner's costs or shopping or other things, you could do that. But the taxman, for example, would not be happy about that. They would not accept that as a genuine expense in incurring the revenue that you've made. And similarly, if you had partners or investors, they may have an issue with it. So again, if we just look at the little example that I've put there for you, again, the cost of goods sold, the way we measure that would be the unit that you've sold times the cost price would give you the cost of purchases or products sold. And if your supplier gave you a discount, for example, then you would have a net cost of goods sold. And then how does that sort of come together in a profit and loss statement? Well, there you can see, so the revenue we've got, the 900 Rand, then you've got the expenses, the cost of goods sold of 350, which would give you a gross profit of 550. And gross profit is a term that's used to reflect the amount of money at a gross level you make per unit of goods sold to your customer, or unit of hour that you've sold to your customer. Below that, then we would take expenses like overheads, salaries, audit fees, accounting fees, marketing, etc., to get us to the income, the net income. So again, very simply put, cost and profit, hopefully that becomes a little bit clearer to you. Then the next concept just to cover would be what's markup versus margin. And I think this is probably the most misunderstood term, I guess, in the world of business, in the world of business and finance, because you can, a markup and a margin are actually the same thing when you talk value, but when you talk a percentage markup or percentage margin, it's a different percent. And you're going to ask yourself, well, why is that possible? How's that possible? Let's take you through it. So on the left-hand side, we've just given you some basic, hopefully it's grade 2 principles of maths. So cost plus how much you want to make as profit to mark up your cost will give you your selling price. Conversely, margin looks at it the other way around, and it says, if I've got a selling price and I deduct my cost, that equals my gross profit. So it kind of looks at it from a different place. Typically, markup is used by someone who knows their cost structure well, like a manufacturer, or someone who's buying goods and on selling them directly with adding no additional value to it. Whereas someone who focuses on selling price first and foremost is really what we call a true marketer, consumer goods type distributor, who's more worried about what's my competitor doing, how much is my competitor selling it for, and making sure that I'm competitive in the marketplace. So for them, selling price would be most important. They would make sure their cost is less than that if they wanted to make a profit. But in both cases, markup and gross profits are the same number. So if we took the example on the right-hand side, if you've got a cost of 100 and you want to mark it up by 20, your selling price would be 120. Okay. Conversely, if you look at the screen going to the right, the selling price minus the profit of 20 will give you a cost of 100, but it's still a profit of 20. So if we work out the percentage markup, it's 20 over the 100, which is the cost, because you're marking it up to the selling price. That'll give you 20%. And for the margin, it is then 16.7%. So you've got a slightly different number coming through. Now, the other principle that you need to be aware of, so this is kind of called your contribution per unit. So at this stage, we're doing a GP of 20%. Now, what's our variable cost? So the variable cost is the cost that varies with the amount of business activity that we undertake. So there are other costs that may be not directly linked to the good or service that you're selling, but also do vary according to the activity that you do. So, if you were a manufacturer, for example, electricity would vary based on the level of production that you use. If you were a transporter, your cost would vary relative to the amount of transport that you're using and the fuel. Your agents that are out there selling on your behalf would then, their cost would vary in terms of commissions linked to the amount of sales that they make. And also your marketing could be linked to the amount of business activity. Those would be examples of what would be a variable cost. And typically, when we look at contribution per unit, we say, what are all the costs that we can associate to the activities that we're incurring to sell those goods? Fixed cost, on the other hand, is something that tends to remain fixed, as the word implies, throughout a period of time that you're measuring, let's say. So whether it's a month, a year, a quarter, that's not going to change immediately without some event or something significant happening. So it's not always directly related to the business activity that you're doing. So for example, anything that's contractual in nature would tend to be a fixed cost. So your rent, typically you're entering into a lease agreement for a minimum 6 months, 12 months, 3 years, 5 years. So it's often difficult to get out of that cost. Same with salaries, you're employing people. And unless you go through a process to restructure your business, you may not necessarily be able to change your cost structure very quickly. Another example would be if you've bought equipment or machinery and you're depreciating that, you've already bought that, or you're paying for it or paying it off. That's a cost that you would then account for over a period of time. So those costs are kind of what we would call sunk costs. They're committed. In a short space of time, you're unable to get out of those. So that's really, in terms of cost structures and different concepts, the kind of key concepts that are there, keeping it as simple as possible again. I mean, yes, you can argue that there are semi-variable costs or semi-fixed costs, which in a short period of time, if you did have an event like the pandemic and you had to make some dramatic decisions, like restructuring your businesses, renegotiating some of your contracts, perhaps those could be considered semi-variable, but typically in the world of business and finance, we tend to be quite clear-cut into which is variable and which is fixed. So next important point coming out of fixed costs, markup margins, variable costs is, how do I know my break even? And what do we know? What does break even mean? Okay, we often hear that word bandied about, but break even, simply put, is how many units do I need to sell, or how many hours of service, if I'm in the service industry, do I need to sell to cover at the bare minimum all my committed costs. So in this case, we'll say fixed costs, because those are the ones in the short term we cannot get out of. So what's the bare minimum that I have to do to at least cover my fixed costs? Okay, so the easiest way to explain it is probably through an example. Okay, so let's say our fixed costs are 1,000 Rand, and that our selling price of each unit is 20. And then we do a whole costing exercise that says, okay, our cost of goods is 8 Rand, and our variable cost that we can allocate to that cost of goods is 4 Rand. So in total, that's 12 Rands worth of variable costs that are allocated to each unit that I sell. So essentially what's happening is our profit per unit is 8 Rand. Or a better way of putting it is our contribution to our business is 8 Rand for every unit that I sell. So if you think about it logically, I've got to cover 1,000 Rand with 8 Rand each time. So if I take 1,000 divided by 8 Rand, it gives me 125 units. Okay, so that's how many units I have to sell, whether it's a day, a week, a month. That's what I have to do in that period of time to at least cover the overhead that I'm committed to. After that, I'm starting to make some money. Conversely, if you want to say, okay, units is a bit complicated, I don't want to keep tracking that all the time, or I don't want to track hours I've built, what's the value that I need to sell? Well, similarly, assuming that you're able to achieve the 20 Rand per unit sold, then the value would be the 125 units times 20 Rand, because that's your selling price. So 2,500 Rands worth of turnover ensures at 8 Rand a unit that I'm able to cover my 1,000 Rands worth of fixed costs. Okay. So hopefully that's understood. Right, so let's talk about an income statement. So we've kind of gone through a process here where we've covered the basic concepts of revenue, profits, expenses. So now we're able to build an income statement. And really, what's the purpose of an income statement? Purpose of an income statement is really to calculate your earnings over a measured period, whatever that is. So again, it could be daily, weekly, but typically it's more likely per month or per year. You know, those are the sort of accepted measurement periods that we use. And for whatever reason, retailers sometimes look at it weekly. They like to be a bit more up to date. But I think most companies out there, you know, it's a lot of time, a lot of effort putting this together. So you don't want to have to be doing it too much and wasting unnecessary money either. The other reason that you have an income statement is you want to have a consistent methodology, so reporting style and measurement standard. And this is so that it can be compared with others. So typically, yes, you as the business owner prepared a profit and loss for your own benefit, but there's also other stakeholders. You know, if you need credit, you may have to supply financials to your suppliers for them to assess your creditworthiness. If you need money from the bank or a funder, or you've got other partners in your business, they're also going to want to know what's going on in the business. And of course, to make it easy for everyone to understand, there's a methodology and a process in which it's all put together. The main difference between an income statement and a profit and loss statement is that the profit and loss tends to focus just on the trading aspects of the business. So again, they would either stop analyzing it at gross profit, typically, and in some business may even go down to net income. And you can see how the sort of income statement goes on the right-hand side. So, you know, it starts at the top with revenue. That's going to be the biggest number. The next should be cost of goods sold. So you deduct your cost of goods sold to get your gross profit. Then you would deduct your expenses to get your net income. And then after that, you measure things that probably you only tend to measure on a not so often basis. So, you know, these would be your sort of non-operating expenses. So for example, interest. The interest is not really the cost of your operation. It's something that you've incurred as a result of financing your operation. Now you had a choice. You could have put in equity in yourself, which would be interest-free. But for this particular case, whoever's being charged the interest has made a decision that they've gone to a funder who's charging them interest to acquire the asset or whatever it is they needed for funding. So then you would look at your net income after interest. And then, of course, if there's any money left SARS will be keenly interested, and they would also want to have their share in the stake. Okay, so that's where your net income after taxation comes. And probably the other point that I neglected to mention up front is, so what about VAT? I mean, that's something that's due to SARS. Well, VAT is never measured in your profit and loss, simply because it's not an income for you. It's not an expense for you. Even though it has a cash flow impact, it's not part of your trading business. It's just something that government requires you to do as a tax collection methodology, which affects your cash flow. So that never comes into the profit and loss, but it does come into your balance sheet, because obviously it's a receivable from whoever you supply goods to, and it's a payable to whoever supplies you the goods. So it's just one of those tricky things to be aware of and remember. And yeah, I mean, as I said there, you know, when you get to net income after taxation, typically that's referred to as the bottom line. So if someone says to you, what's the bottom line? You know, they want to know what's the final net income after everybody else has had their share deducted. So, you know, I haven't shown dividends or anything there. That would also come off as an example, and the bottom line would then be after dividends. Some of the key sort of measurements that come out of the profit and loss statement or the income statement would be the GP percentage. So when someone asks you what GP are you making or what margin are you making, typically they're saying, you know, what percentage is that GP as a percentage of revenue? So in this case, 550 divided by 900 would be the percentage that you make. Other ones, particularly people involved in funding your business, will be interested in net income before interest and tax. So that's after expenses. They want to know kind of what's the total cost of running your business, but before investment costs. Often it's called EBITDA. So when we get into sort of business 102 as opposed to business 101, we'll start to explain some of the subtle differences that financiers and funders would look at. But essentially, it's exactly the same thing. What's your EBITDA or your NIBIT? And then the final one is net income after tax. You know, that's kind of the bottom line again. So what's your bottom line? So the next big thing is assets versus liabilities. So we've got a profit and loss, but, you know, how do we know exactly where we are? So assets and liabilities tend to give us more of a sort of situational assessment. And, you know, simply put, assets are, I've got all of these things that can earn me income. What is their value today versus the amount of liabilities that I have to pay? So I've bought things, I've sold things, I've got cash that can come into my business versus the cash that I need to pay out. And if I did that today, what would my net position look like? And that's really where your owner's equity comes in. So assets minus liabilities, as you can see there, equals your owner's equity. So what's due to me as the owner, what's left for me in my business if I did this assessment. Okay, so here on the asset side, typically you would have a bunch of different categories that we would assess. Fixed assets being probably one of the larger ones. So, you know, what would a fixed asset be? It could be property that you've bought or buildings that you've got. Obviously, you need to be the owner of those. Machinery and vehicles. And yeah, typically the way we measure a balance sheet is at cost. Why not at selling price? Well, because one of the fundamental principles of accounting is that you cannot recognize future revenues until they're actually earned. So when we do an asset evaluation, we look at the value based on what it cost us. Or if we think we're going to sell it and it's going to be less than that cost, then we would discount that value. So hence you get depreciation of assets. So over time, through wear and tear, your asset would be depreciated. Now, at some stage, you may sell it at a profit or a loss. You would recognize it then. But in terms of measuring a balance sheet or your assets today, typically the accepted standard is cost. Similarly, then we would look at fixed assets as a longer term asset, because you're not going to be buying and selling property if you're in a trading business on a daily or weekly, monthly basis. That's going to happen as an event once or twice in the lifetime of the business. Inventory, now that's your stock. That's your stock in trade. That's what you're doing business with. So assuming that you're in a trading goods environment, that's what you've got. And typically there again, it's how much did you buy it from your supplier? If your supplier gave you a discount, then you would put it on the balance sheet at the net price after the discount, because that's the true cost. And there you would also check it against sales value. So we call it net realizable value in the sort of accounting field. If that value is above, all's good. If the value is below that, then you would make a provision for depreciation of stock value, slow moving stock, or whatever you wanted to call it. Similarly, the same principle under receivables. Mostly receivables will be your trading receivables. So you've sold that stock to a customer. That customer now owes you money for those goods because you've given them 30 or 60 days credit. And again, you would measure that at the selling price this time, because you have now realized the sale and you've transferred the goods to them. They're now the owners of the goods, and they need to pay you back that money, including the VAT. So the VAT that you're going to receive will sit also as an asset, cash to be received on your balance sheet. But again, you would look at the aging of your debtors, and if people are now at 90, 120, 150 days, you'd have to make a decision. Am I going to recover that money or not? Or do I make a provision, or do I write it off and bring down the value that I think I'm going to recover for that receivable? Then the other receivable that we tend to see, particularly on smaller businesses, is a shareholder's loan. Now, a shareholder's loan as an asset means that the shareholder owes the company the money, i.e. the shareholder has taken that money out of the company or has borrowed that money from the company for whatever reason. So again, it depends on the reason that the money has been used for. If it's gone into another business that you're running, maybe it is an asset. If it's gone to you buying yourself a Porsche or Lamborghini, then maybe there's risk that you may not be able to repay the company that money if at any time you need to pay back the money. And therefore, one would have to seriously consider as to whether it's receivable or not. So that for me would be the question to everyone out there that sits with a shareholder's loan. And then cash then becomes the most liquid of all your assets. I mean, it's in your bank. You can do with it what you want. If you haven't put it in an investment or a 30-day notice account, then that money is really the most liquid asset that you sit on your balance sheet with. Now, conversely, again, as I said, a liability is the money that the company, not you as an individual, but the company owes to whoever has advanced credit or given loans to the business, or needs to be paid over on behalf of the employees of the company because you've collected it for government or whomever else. So for example, your liabilities typically would be any shareholders' loans, any loans to the banks, investors that have invested in your business could be a liability. Usually one of the main liabilities would then be your trade creditors. So like you've got trade debtors, you need to buy the goods or the materials to make the product to sell to your customers. So hopefully you're able to get credit from your suppliers and you still owe them 30 days, 60 days, whatever the terms are. And then don't forget that you also have other obligations to pay over municipal taxes, PAYE, commissions to your staff, salaries if they're not already paid by the month end, government taxes like the VAT, income tax, and then any other contractual commitments that you've got with service providers would go under other creditors. So again, the purpose of this is a situation report. It's at a point in time. You total up your assets, you total up your liabilities, and the net amount left should be what you as the owner of the business have due to you. And obviously, if there's several of you as owners in the business, then you need to share that amongst yourselves in proportion to whatever your ownership agreement says. So again, what's this all leading towards? It's leading towards the balance sheet, okay? So essentially, the balance sheet is a state of the financial position of the company at a specific date. And as I said, a situation report. Again, the purpose is to do it in a consistent reporting style and a measurement standard so that you're able to compare your results or your assets versus liabilities in a manner that's accepted, generally accepted out there in the marketplace, whether it's for your investors, your stakeholders, yourself. And it really gives you a state of health check of the business, okay? And often we call assets minus liabilities the net asset value, net being after you've deducted the liabilities. And really, again, just to reemphasize, there's a basis of measurement, which is a generally accepted accounting principle and standard in the financial industry, which says that we measure our business today on the basis that we continue to trade for the foreseeable future. So the operating conditions we're in are not excessively bad, they're not excessively good. We may measure on a standard that says tomorrow I'll still be in business, I'll still be able to repay my debts, I'll still be able to get credit, I'll still be able to service my customers. If, for example, like we saw during the pandemic with COVID, that something changes, you're no longer able to trade for whatever reason, business shutdown, lockdown, or there's an event that comes along that creates a disaster and it makes you temporarily unable to trade or do your business, then a different set of criteria may be used. If you've got to do a fire sale on your assets, suddenly the value of your asset at cost may not be a true value, and you may have to discount the value of your assets to do a proper measure. So again, the basis is on a going concern as if world is working in a normal environment. So kind of just putting it together in a document, what does a balance sheet look like? This is just a simple example of a balance sheet. So again, you've got your assets where we go through the fixed assets, inventory, debtors, cash, could have had shareholders loan in there. Okay, let's say, for example, the total asset value is 525 Rand. Then you total up your liabilities. So in this case, we've got some loans, some creditors, other creditors, and the total liabilities is 450 Rand. That would leave us with a net asset position of 75 Rand. Okay. And now, why is it called a balance sheet? Well, it's a balance sheet because in accounting, everything is done through what they call a double entry system. So, you know, for every debit, there's a credit. So everything needs to balance, whether it's an income or whether it's sitting as an asset and liability, it just magically balances. So in this case, the balancing part of it is the shareholders' funds or the owner's equity, where this is usually represented by share capital, what you put into the business, and any profit that you've accumulated to date. So the profit comes out of your trading, where you've managed to sell assets at a higher price than you've incurred liabilities, giving you some profit, and that stays in the retained income column. So essentially your profit and loss comes in under retained income and everything balances. So that's why it's called a balance sheet, and it's a simple equation: assets minus liabilities equals owner's equity or shareholders' funds are the terms that are used. Okay, so out of all of this, yes, we know what the owner's equity is, we know assets, we know liabilities, but I mean, so what? You know, at the end of the day, those items are largely on credit. It's not necessarily cash. So can I effectively go today and buy more goods and services? Can I trade? You know, what's my reality? So I think, as you all know, you know, particularly for small businesses, you know, cash, why is cash king? Well, I've put in here cash and credit lines. I think it's becoming accepted in our world today that credit is just as important as cash, and your reputation drives your ability to get credit, as does your profitability and the state of your balance sheet. But with credit, it certainly buys you time to turn assets into cash and to keep your business turning over. You know, so cash is the fundamental in the world that we work on, but credit is becoming more and more an option that we can utilize. But if you can't get credit, then cash is really key to your success. So for any business, you know, you want to make sure that you're able to turn, and that's a phrase that I probably didn't explain, but a turn would be something like your stock turn, is how often can I turn the stock that I buy into cash, so that I can buy more to turn it into cash again. And that's the key principle. You know, you're in a trading environment, you need to turn your assets over into cash as fast as you possibly can, so that you can pay off all the credit and the debt that you owe when it's due. Otherwise, you're going to sit with the problem, and that your creditors are starting to harass you and chase you for more money. Okay, so if you bought a vehicle through a finance house, whether would the amount owing reflect, and what do they mean by a depreciating vehicle? So the purchase of the fixed assets, okay, if you think about it, and again, we're talking about a double entry system of accounting. Let's say you bought 200 Rands worth of assets today, then your entry would be to show assets as 200, but you haven't paid for it. So you've got a liability to the bank. So you would show that as a loan to the bank or from the bank under liability. So on your balance sheet, you would have 200 under assets, 200 under liability, and your net asset value would be 0. Okay. So again, that means you've got no income coming in. It's not measured in owner's equity. It's basically an offset entry that sits on your balance sheet. Now, when you repay that amount, obviously what happens then is that money has to come out of cash. So you would reduce your cash balance, the 50 Rand that's shown there, let's say by 10 Rand, and you would reduce your loan balance by 10 Rand. So your net asset value again remains unchanged because the asset's gone down by 10, liability's gone down by 10, net position remains unchanged. Now, the depreciation principle basically says that if you buy an asset and it's not an asset that you're going to trade like stock, but it's a fixed asset, then it has a lifespan. And over that lifespan, you would recognize that it's a cost to you and you depreciate it. So we don't charge the cost of the asset up front to the profit and loss account. It goes to the balance sheet. As you use the asset, then what would happen is the 20 Rand depreciation, let's call it that, for the year, would then reduce the value of the asset on the balance sheet, but you're not reducing the liability in this case, you're reducing your income because you're going to charge the use of that asset to your income statement. So your retained income would reduce by 10. So in this case, your asset value would reduce by 10, your net asset value would reduce by 10, and your owner's equity would also reduce by 10, and the balance sheet remains balanced. Okay, so we've kind of been through a rapid move through assets, liabilities, balance sheets, income statements. And yeah, they give you what we would call a financial overview of how your business results look and how your business is performing. But I mean, is this the only thing you should look at? Is this the only metric as a business owner that tells you whether or not your business is on the right track, or whether you're winning or losing? So, definitely we believe it's not. At the end of the day, those are just the outcomes of a lot of events and activities that have taken place to get there. And what's more important is we look at things like key performance indicators that assess what we're doing to get there. So, that's the one principle. And then the other principle is, again, this balancing is, well, again, why, should we only look at financial indicators? What are the other things that drive the success of the business? And that's where the principle of a balanced scorecard comes in. So it says we should look at things not only from a financial perspective, but we should look at it from a business process perspective, which is efficiency, innovation, all sorts of different ways that you get smarter and smarter at getting the activities and benefits of your business across to your customer. Also, you should look at your customer's view. What does the customer think of your business? How do they recognize you? How do they accept you? Are they coming back for repeat business? Do they like the quality of your product? And then also perhaps from a staff perspective, the learning and growth perspective, are your employees contributing? Are they able to contribute more? Are they satisfied? Are they motivated? All of these different aspects should be considered because they're the drivers that really lead to the outcome that gets measured in the profit and loss or in the balance sheet. So I've given some examples here of things that different businesses would probably look at. So GP and margin, break even. And I forgot to mention, I've got a nice example. I had a client come to me last week, and they just invested in a franchise in a fuel station. And after month one, they didn't have enough cash in the business to pay off all their costs for the next month. So the first question I asked is, okay, so you're in the fuel business, you've got a petrol station. How much money do you make for every liter that you pump? And he said, I've got to go and ask my accountant. So I said, okay, so when's your accountant going to give you that information? He says, no, when my accounting month-end report comes out. I said, but you're doing this every hour, every minute, every day. Why don't you know that every day? At the end of the day, you know, what does it cost us for a litre of petrol? 15, 16 Rand now. There's probably half of it goes to the government, some more goes to the fuel companies. But out of that, there's got to be, you know, 5 Rand or whatever it is, 3 Rand, that's the pump operator, the fuel station's share of that business. And predominantly that's cash, right? I mean, most people that come to a filling station pay cash or on a credit card, which basically gets turned into cash within 24 hours. So then I asked him, okay, but then do you have any accounts? Do you give credit to anyone? He said, yes. Now I've got a couple of big corporate customers. I said, okay, so, you know, what percentage of your business is cash and what percentage of your business is credit? No, he wasn't sure. I said, okay, well, you know, what did you plan? No, we planned 100% cash. I said, okay, that's fine. So that's great. So you bought this fuel. When do you pay the fuel operator for delivering the fuel? He says, no, they've got a debit order every 48 hours. I said, wow, okay, so every 48 hours, whatever it's costing you is going out of your bank account, and whatever you get in cash, hopefully is bigger than the amount, or you're already going into negative cash flow. And that's before you've paid wages or done anything. So again, I mean, it's just some fundamental principles that you've got to know what your key drivers are in your business and what are the key performance indicators. Now, those are financial and cash, but things like, you know, what's in my pipeline? If you're out there selling, you know, how many new customers do you have in the pipeline? How many new product offerings do you have in the pipeline? How often are you getting the opportunity to come back for repeat business with your customer? Are you measuring that? How much of your business gets returned? How much is it for quality reasons? If you're a manufacturer, how much is wasted? How much is that effectively costing you in terms of profit potential? You know, in the .com era with lots of stuff being done digitally today, you know, what's the cost of acquiring customers? How much are you spending on digital communication? How much are you spending on electronic communication, developing websites, all of this kind of stuff? The world has changed, but still we need to track and monitor it. Do we ever do a customer satisfaction survey? You know, do they like what we do? If we're a service provider, perhaps that's more important than a product supplier. Do we rely on referrals? What's our referral rate? You know, our staff turning over. I mean, at the end of the day, you know, we invest in staff, staff perform, staff learn probably 80% on the job. So every day they work for you, you're investing in them. And yeah, they're contributing and they're giving back to you. But if you lose them, that's an investment cost that you've lost, and you start again. Because the next person coming in, you're going to have to repeat that process. So yeah, I mean, there's many different metrics, you know, all of them kind of filter through to how you look at your business. You know, I think my challenge to you is go back to your businesses today and figure that out, because the minute you do that, you'll start to focus on what's really, really important to moving forward, and making sure that that balance sheet and that income statement start to go the way that you want it to go. So essentially, we went through some concepts: cost and profit, markup and margin, how to read an income statement, what's an asset versus a liability, which then equals net asset value or owner's equity, how to read a balance sheet, why is cash king? Now, I really haven't covered much on cash today, and as a sort of sneak peek of what's coming next time, you know, we've got 2 more sessions lined up with the Siaka team. One will be on financial analysis and planning, which we will include cash and cash flow in there. And the one after that will be getting yourself funding ready. And are you funding ready, where we will start to talk to you about what funders look for, what's key to them, and some tips and tricks on what you can do to make your business more appealing to a potential partner or investor in your business.